Hi, welcome to Market a Minute. So, as you know, we have a loss averse investing strategy where we like to get there early, identify the opportunities, get positioned, and then let the opportunities play out. We don't buy high and sell higher. That's not what we're looking to do. We're looking at buying low and selling high. So right now, the markets went down quite a bit. They rallied quite a bit, almost all the way back to where they started. So we're wondering, okay, is it time to sell now? The markets are overbought in a big way. However, our model, our tactical model, isn't telling us to sell. And we're still seeing some great opportunities in the blue chip and small cap space and in the income stocks. Before we start, I want to tell you a funny story. So I woke up on Saturday night sweating and thinking that was like the worst nightmare I've ever had in my life. I dreamt that the Buckeyes lost to the Wolverines again this year for the fourth year in a row. Yeah, it's football season, and there's not a chance in hell that the Buckeyes are losing to the Wolverines this year. So, looking at the economic speech that Powell's going to do on Friday. So, this is from Jackson Hole. It's their annual symposium. A lot of economists get together, central bankers around the world come in, and they have a discussion. The topic this year is about reassessing the effectiveness of transmission of monetary policy. That sounds like a lot of fun, doesn't it? Sure glad I'm not there. But anyhow, we think Powell is going to give the wink again that he's going to cut rates, but he's going to do it prudently and not to rekindle inflation. So maybe a little slower than expected until the economy really starts to roll over. So, a couple key points is one is the 2-year Treasury correlates really highly with the federal funds rate, and so you can look at this chart here. This is over roughly 48 years. You can hardly see the difference between the two, right? Okay, so we tighten this up so you can see the difference here currently. So the red is the federal funds rate and the blue is the 2-year Treasury. As you can see, the 2-year Treasury is out ahead of the federal funds rate. So the Federal Reserve generally lags everything. The market figures it out and goes there first, and the Federal Reserve follows. Right now, we're about 1.5% difference in spread between the federal funds rate and the 2-year Treasury. So we think that the market is now discounting roughly 1.5% decline in the federal funds rate in a reasonable period of time. So currently, the 2-year Treasury on 4% is discounting that 1.5% cut in interest rates. So with the CPI currently at 2.9, we expect that the terminal rate right now, as we're looking at it, is about 3%. We kind of feel like maybe it's going to be lower than that. We're going to get more cuts than what we currently expect. So, looking at the federal funds rate and recessions, this is kind of interesting. Okay, we went back. Now, this is over a longer period of time. This is all the way back to the 1950s. And so in the 50s, interest rates were lower. And when they cut rates is about roughly 2% when they would cut rates as the recession is starting. As you can see this chart, it's generally when they're cutting rates, the recession actually officially begins, roughly speaking. So the spread between where they start and where they end, it ends up to be about a 2% drop all the way up to about a 6% drop. And you look through here is much larger than that. This was in the 1980s, but we stalled out a little bit in 1984, and then the federal funds rate continued to go lower. So we look at this as one big interest rate cut through here. But you can look at the past two real recessions. You had roughly a 5% drop in the federal funds rate. And so you're wondering, okay, what's it going to be this time? Is it 2? Is it 5? So we're kind of leaning to being, instead of 2%, kind of where the market is currently, kind of thinking, or 1.5, we think it's going to end up being more than that because the economy is going to end up being a little weaker than everybody believes in our our expectations. So looking at the 10-year Treasury, and I'll get to this in a minute, but looking at the 10-year Treasury minus the federal funds rate. So my point with all this is that the 10-year Treasury is the all-important rate that determines the valuation of the stock market. So 10-year Treasury is very important, and we're currently overvalued on where the 10-year Treasury is at this point in time. So we're looking at the 10-year Treasury minus the federal funds rate. And as you can see, as the recession occurs, you get big cuts in interest rates. The federal funds rate drops very quickly, much faster than what the 10-year Treasury does. And you get this spread of about 2.5% over time. That's where the 10-year Treasury goes. So 2.5% above the federal funds rate. So this is kind of important. It's really technical, and sorry about that, but this is kind of important. So if you go to 3% on the federal funds rate, you add 2.5% to it, you're at 5.5% on the 10-year Treasury. So is the market expecting maybe more inflation occurring? That's why that 10-year Treasury goes up to 5%, 5.5%. Or does the federal funds rate go lower than what the market's currently expecting? So we look back at this and we say, okay, well, maybe the stock market is not getting this right, and maybe the market is just way overvalued, maybe ridiculously overvalued. If the 10-year Treasury goes back to 5.5%, the stock market is extremely overvalued. So we're kind of leaning to the other side. We're leaning that the federal funds rate is going to go a lot lower than expected. You have to wonder why Warren Buffett has so much cash at this point, right? Okay, so getting to the point, we're looking at the chart of the S&P 500. Actually, we're not surprised it declined. We expected that decline. It held support, more or less as we expected, held support. It broke through that resistance line there above the 100-day, above the 20, and above the 50. So we're rather surprised you got this big bounce here. So this creates a big overbought condition. So we're back to close to where we started. Not a whole lot has changed. Maybe the market's thinking, okay, we're a little better off economically than what we expected prior to the decline. We're not sure about that. The yen carry trade, sorry, that's not over. So as the Federal Reserve cuts interest rates and the Bank of Japan raises interest rates, we think the yen will probably strengthen, and then the yen carry trade comes back. We're not sure how much is still left on that yen carry trade. They're saying, that there's $4 trillion that was in place. There's no way that was unwound. So we have that kind of overhanging there. Overhangs the mega cap stocks. Big data point coming. NVIDIA reports on August 28th, so next Wednesday. That's a key data point. We think more or less everybody understands what NVIDIA is going to report. There might be some upside, but we don't think it's going to have a big move upward, uptrend. So we think the mega cap stocks are vulnerable to more rotation out of those stocks in the blue chip stocks. That's where you got to go first, in the blue chip stocks. So recently, what we did, we had bought some Starbucks very nicely, thank you. We bought some Starbucks, and then when they hired their new CEO, stock had a big pop. He came from Chipotle. We think that probably reflects the value in Starbucks. And so we rotated into Chipotle at this point, CMG. So we think there's some more upside to go in CMG. However, it's bounced off the bottom that occurred on the day the CEO resigned. So we think there's opportunities out there. Things come around. There's some earnings reports this week on the retailers. We think that's going to surprise some opportunities. Target reports this week. We're looking at buying Target. We think there might be another shoe to drop. We don't think they're gaining market share like Walmart is. So if Target has a tough quarter, trades down in a significant way, we'd be a buyer of that stock. So focus on blue chips, focus on quality income stocks. We do have some really interesting income-oriented names, and then small caps opportunistically. Now, I really like Grail. It's a small cap biotechnology stock. We talked about that before. It's the one that detects 50 different cancers with a blood test early, so you can survive cancer. We like that one a lot, but we have a lot of others in our biotechnology strategy that we think have a lot of catalysts going forward between now and year end and into next year. Our message this week is market decline, big bounce back to where it was. We're looking at some point to get defensive again. We don't think it's quite there yet, but we're not too far off. September can be a really tough month, and it can continue in October. And we are in the midst of the craziest political situation, election that I can remember in my lifetime. Harris's economic plan, it's ugly. You know, that's just, even the Democrats don't get it. On the Republican side, Donald Trump has this locked up. If he can just shut his mouth, he needs to talk about the different policies between the two. His policies are so much better than her policies. So he could easily lose this election if he continues with the personal tax. We think it is important on this election. The policies of Trump is what we need to get another leg up in the economy. And then Harris's policies will not be good for the overall stock market. So either way, we're ready to play ball, and thank goodness football season's coming up again. So take care, and we look for any of your comments. And come to my website, Patrick Adams CFA, and sign up for Market in a Minute. Get a hard copy of it, and let me know if you have any questions. Take care.